Good afternoon, everybody. We're going to start our 1 o'clock session. And we have another panel of individuals who are very passionate about the topic of retirement income and helping people retire better. So if everyone will just introduce themselves, tell us who you are, what you do, and we'll get started. Scott, you want to start?
Scott Colangelo. I'm chairman of Prime Capital. We run a wealth management and retirement practice under the name Qualified Plan Advisors.
And good afternoon. I'm Matt Condos. I'm in charge of product development for Lincoln Financial.
Hello, I'm Doug McIntosh, and I am the older, less better-looking Matt Condos for Prudential Retirement.
With the same hairdo.
And I'm Michael Schaefer, and I'm with SS&C Retirement Solutions, formerly DST Retirement Solutions, and I'll be your moderator today. Okay, so in-plan retirement income is back in the spotlight again, due to several reasons: pending legislation such as RISA and the Secure Act, continually evolving demographics. What I thought was really interesting, though, is that Willis Towers Watson did a 2019 Lifetime Income Solutions survey, and what's very positive for this industry is currently 30% of employers say that they have now adopted one or more lifetime income solutions, as opposed to 2016 when that number was 23%. So we've got the curve going in the right direction. I think the real story, though, when I kept reading the study, of the plan sponsors who hadn't yet adopted a solution, 60% say they would consider offering a lifetime income solution at some point in the future. So I think plan sponsors are starting to get the message that the idea of a defined contribution plan has evolved, and thinking about retirement outcomes and retirement income is definitely something that they need to be thinking about on behalf of their employees. So, in-plan income solutions have been around for a long time. What has been or what is hindering plan sponsor adoption of these products? Anybody like to start?
I mean, I can tell you from the advisor's perspective, we just talked about this at lunch, but the advisor community's failed at it. I mean, I'm an advisor. I think that if you want to be honest, the complexity of the solutions out there, it's just easier just to kind of poo-poo it than talk about it and get educated. And we've been so focused on compressing fees and focus on performance as opposed to outcomes that I think the advisor community has been a hindrance. I mean, you look at like Doug and Prudential and some of the unique things they've built the last 10 years. I mean, they've been ahead of this. And so, I mean, there's been solutions if you want them. It's just a question of, are the advisors going to present it, and is there going to be utilization?
Okay.
I'll go next, I guess.
Let's get in the way.
So you touched a little bit upon the cost and complexity in your comments there, and I think that's definitely a challenge. I think the industry, in terms of bringing forward solutions in the past, has been really looking at porting over solutions from the retail space, and there's a number of bells and whistles on there. In our attempt to try to provide something that is customizable and provide a unique solution, I think we stumbled a bit in terms of the simplicity and the benefits given to a simpler type product approach that can be rolled out and serve the masses better.
Well, Mike, I guess I would let's focus on some of the positives as well.
Okay.
There's an enormous amount of innovation going on right now in both the guaranteed and the non-guaranteed space, and I do believe you used the analogy of a trend line.
Slope of the line.
It is sloping upwards. There's no question about it. And in particular, in the non-guaranteed world, it's easier to move faster because there's a lower regulatory burden. From our perspective, and we're one of the players that's been around for a while, the incompletely evolved regulatory environment as it applies to portability is probably the single biggest issue. We like to talk a lot about safe harbor. We have a safe harbor. We're looking at an expansion of the safe harbor in the Secure Act and in the Family Savings Act and in the Apartment Garden Bill and what used to be RISA. And that'll be helpful, but the portability provision, I think, is the most important one. And then the prior, for those of you who were here in the session just before lunch, there was a little bit of discussion about the portability provision, which would facilitate the movement of assets to a retail solution if a plan sponsor decided to discontinue that solution for whatever reason. And that, I think, is going to be very helpful in this space.
Perfect. I would also add, from a participant perspective, that probably the demand hasn't been there to push plan sponsors to have these type of solutions. And for those of you who don't know, I spent a few years running the retirement income area of New York Life's agency business, and we always said annuities were sold. And I know we're talking more broadly than just annuities. They're sold, not bought. I know we're talking more broadly than just annuities today, but I think that is true that not every participant understands the economics of the distribution phase. And I think because that demand hasn't been there, I think that's another reason why there's just been such slow adoption. But obviously very good that it's heading in the right way.
Doug and I, he teed that up for now.
I'm going to double click on that for 2 seconds. I think we and then Scott can say, no, that's not what I was going to say. If we were to say to participants, how badly do you want auto escalation? They would say, not badly. And yet they need it pretty badly. So we shouldn't be constrained by what participants think they need. We need to be a little bit more forward thinking and incorporate behavioral principles.
Can't build faster horses to get to the next level, you know?
And Jim's, I don't know if Jim's in here, I thought his comments were fantastic in the last session. He was talking about simplicity, but also he was talking about it has to be a QDIA. As advisors, we've got to get out there and say, let's default everyone 50 and older. I mean, they can opt out and use like a bifurcated structure where you keep the current core funds, keep the current target dates, and then default the 50 and over as long as it's a good solution. And then you're going to get, it's just naturally going to happen. Everyone's talking about decumulation. I mean, we probably should have been talking about it since 2013 when more money was going out of plans than coming in. That was the first year. And we're just now talking about it today. But, you know, really ultimately from a participant standpoint, we're talking about decumulation, but actually these guarantees, what it does is it helps their behavior overall. They'll save more, they'll stay invested in bad markets. I mean, how many people do you know that owned a variable annuity with a guarantee and they never freaked out during the financial crisis, but people that own stock portfolios, mutual funds, things like that did and made bad decisions. So it's a bigger story than just decumulation. It's overall investor behavior will get far better, savings rates will go up. I mean, participants have been telling us Vanguard does that, what is it, How America Saves, and Deloitte does the annual benchmarking survey. They've been doing that every year, and every year they ask the same questions, why participants don't save more, and 85% of them say they're either scared of the investments or don't understand them, and 85% of the plan sponsors say they don't save more because they can't afford to. There's a massive disconnect in our industry between reality and what participants actually think, and they'll save. They will definitely save. People think they won't, they'll save.
Okay. Well, more importantly, and we did touch on this a little bit, how do we do better? How do we improve adoption of these in-plan products? So, Doug, I know you hit on it a little bit, but what else could we be doing better?
Well, Scott touched on it as well. Thinking about a holistic default that has outcomes in mind, I think is the way we need to go from this point forward. We acknowledge, I think everyone in this room would agree with this, that the defined contribution plan has to be the cornerstone going forward. Those folks who still have a DB plan are lucky, but their kids likely won't. And so a holistic focus on what gets folks to outcomes, and a change in the way we look at metrics. You know, we can certainly, and we should, continue to think about why outperformance against the benchmark is important, but for the participant for the employee who is not in the plan, that's irrelevant. And so things like participation rate are as important as beating a benchmark. And then looking at things like how prepared am I for retirement? What is my amount saved at each, let's say, decade? What is the my likely ability to generate retirement income when I'm in a pre-retirement phase, say the last 5 years of my working years? Those have to be metrics that are front and center for sponsors, advisors.
Absolutely.
I would just add that I think another element to bring in here is really conversations with sponsors and advisors about what is the goal of the plan, what is the outlook for their participant base, what do they offer in terms of other benefits. And so bringing this together, talking a little bit about reframing the conversation of having this be a retirement income plan versus a retirement savings plan, and in building out that retirement tier in terms of number of options that are available to folks, I think is a key part of the other stuff that you guys were talking about. So another key element to bring in there.
I don't have anything to add. I think they said it.
Yeah. Okay. So, we've been talking about various constituencies, which is great, because I think a lot of these conversations focus solely on plan sponsors increasing adoption, but obviously advisors and participants still need to be educated on retirement income options and strategies in order for the products to have a meaningful impact. And I know, Scott, you had just said advisors aren't where they need to be. A scale of 1 to 10, where do you think they are?
I mean, even our own firm, they're very low. I don't think they're having the conversations at all. And now, I mean, to Doug's point, there's a lot of innovation that's coming, and there's going to be better products, so it is going to help the dialogue. I mean, it's some of the products were just too complex, and when you're stuck at with one product or one record keeper, and you're an advisor, and you're like, boy, portability scares me, and those are real issues. And I think that a lot of companies are putting a lot of money and time into innovating these products. So I think we're going to see some really neat stuff that will help those conversations be easier for advisors. But and we've talked, the three of us have talked a lot about this. We ultimately, it has to be simple out of the gate, and I think we started with complex. You know what I mean? And we're talking we're talking about terms like QLACs and all these things. The reality is most participants don't understand their target dates. And so whatever goes out, whatever's brought to the market has to be simple. And I think that palette that will be the first time that it will really be considered. And then that will lead to an evolution of education. I mean, look at how much target dates have evolved and all the different products they continue to evolve. You don't start with the complex, and we've done that in the retirement income space. We've got to start simple, really basic, inexpensive type of thing that solves problems, and then introduce products over time that will be more complex, and people will have them, and they'll get it. Once they open their eyes to it, they'll start looking for improvements on it. You know what I mean? So.
Okay. So moving with the idea of where advisors are, Matt, do you have any thoughts on that?
Yeah, I think building upon what you just said, like it's incumbent upon the industry to roll out something that folks can understand right out of the gate, like you said. And I think it's at times perhaps a bit unfair to participants as I think about the auto evolution with somebody being auto-enrolled, auto-invested, auto-rebalanced, auto-escalate, potentially auto-portability, and then to ask them to make a decision when they turn 65 about what are they going to do with income. So I think you're spot on in terms of it's got to be built in there, and also thinking about the customer experience.
Yeah.
And what does that look like? In my head, I think about it in 3 phases. One is that customer experience during the working years and during accumulation, and this is a little bit back to my comments about reframing the plan and retirement income. And then the customer experience around election of income. What does that look like? What tools are available? Is it something that's defaulted, or is there some additional optionality available? And then I think about third piece was really the receipt of that income. And what does that look like? How is it combined with other things in the plan, other things going on in that person's life? Those are all areas where I think we can do a better job on, and that will bring the rest of the industry along and help advisors have these conversations and talk to their plans about it.
Yeah.
Doug, I'll ask you the same question, but I also want to add a little bit. You had mentioned something, if I can summarize it, Scott, it almost seems simplicity over features is the way to go for advisors.
I mean, that's just my belief. I'm not saying that's right.
Yeah,
but
oh, no, absolutely. I just want to get your perspective. But I'd love to hear your perspective on that as well, Doug.
Well, I'm going to take a slightly contrarian view just because I'm the third guy to comment on this in the line. And what I'll say is I think as an industry, we need to give ourselves a little bit more credit. We like to say they're complex, they're hard to understand, et cetera, et cetera. Let me offer a very, if I may, quick anecdote about a day in the life of an investment dweeb. On Friday, I had a conversation with someone in one of our investment shops about the components of the Saudi index. And the fact that, and this is not private, this is public news, Saudi Aramco is going to list. And it is going to change the Saudi index, indeed the entire emerging market equity index, very significantly. And you could see why it's important for an asset manager to have access to Aramco when it does finally list directly. The challenge is it's going to list in Jeddah or Riyadh or wherever I'm embarrassed to say, I don't know where the Saudi stock exchange is. And you might want to access that name in order to tilt or express an opinion about something completely unrelated, not unrelated, something that doesn't have directly to do with Saudi Arabia. Where is energy going, for example? What's going on with Middle East geopolitics? Who in this room has no idea what I'm talking about right now? Well, most of you understand that. That if you were to say what I just said at a cocktail party or at a backyard barbecue, everyone would be like, you need to either stop having beer or have a lot more. We are a lot smarter than we give ourselves credit for. Those of us, Matt, Scott, Mike, me, who've immersed ourselves in the realities of income, we sort of live and breathe it. It doesn't mean that we're special, weird people. We're normal Joes and Janes, and others can get there as well. So I would say a little bit of application, and helped by folks who are, industry insiders and been at it for a while, and we're very ready, willing, and able to have the dialogue, and we'll all get where we need to be.
Okay. But today, would you say advisors are where they need to be, broad strokes, generally speaking?
With these guys, there's a lot of good work that we all have to do together, and we can move that curve upward as well.
Absolutely. Okay, very good. So let's talk about participant adoption. I think one of the interesting things here, right, it's not just about plan sponsor adoption, where I think a lot of us focus. In order for these in-plan products to really have a meaningful impact, there's several sort of sales that need to be made. So you have the plan sponsor needs to adopt it. You need the advisor that may need to help the plan sponsor adopt it and also help participants. But then you get to the end of the chain, and ultimately it's the participant that needs to feel like this is a good decision and this is something I want to do. And to be quite frank, for a lot of participants, even if it's not a real check, it's the largest virtual check that many participants are ever going to write in their entire lives, is converting their assets into some form of income through some vehicle. So let's talk about participants a little bit. Where do you think participants are? And then also, how do we get greater adoption rates with participants? I guess we'll go in order again, Scott.
Yeah, I mean, like I said earlier, I think it has to be a QDIA. I think that a lot of people maybe don't believe it, but participants do trust their employers for their benefits, for their retirement. If we auto them at 3, they trust 3 is the right amount to save, and so we need to auto them higher, right? And there's things that we have the ability to influence their lives, but participants will adopt it if it's like an auto feature from the start, and they'll learn from it. And this is the anti-fee, evolution that's about to happen with these products, because these are not going to be inexpensive products. I mean, they're going to be inexpensive for what they're getting, and they're going to be certainly cheaper because you have big books of business, so it's going to be less expensive than going out and buying a retail product. But I mean, you're talking, you're going to be in that 100, 115 basis point range, probably all in, and maybe a little higher, which could be 10 times what they're paying for their index fund right now. But I don't think anyone would disagree it's what we should be doing for them. And think about it, the biggest topic today is financial wellness. Financial wellness has kind of leapfrogged the in-plan income conversation lately. And why? They're stressed. And this is like the one thing that can remove a lot of uncertainty and give them peace of mind, so they'll save more, stay invested. You can take a big stressor off the table for them and let them focus on other things in their life that they need to maybe focus on, college savings and healthcare and all those types of things. So
before we go to Matt, Scott, if I had to ask, if you're in front of a participant today, what's your elevator pitch about income to someone who's a retiree? What would you say to get them to bite and start educating themselves?
I'd probably start with what's more important to you, the return of your money or the return on your money. Pretty basic question. Almost all of them will tell you they just want to make sure they don't lose their money. And if they say that, then it's a pretty simple dialogue. They're not going to ask you how much it costs. They're not going to, it's going to be, how does it work? What's the guarantee look like? And it's got, again, I think it has to be simple in its form so that they get it, they can remember it. It's not complex at all. And So yeah, I mean, that would be my pitch. I just ask them what their priority was.
Okay.
So.
So Matt, where are participants and how do we do better with participants?
You know, at the risk of sounding a little bit more towards the complexity side, I do think that there's got to be some options there, because you're going to get a different answer to that question.
Yeah.
You know, there could be somebody on one side or the other. And so I think we get participants there by having overall simple products, but ones that solve different needs within the plan. So I don't believe that it's a one-size-fits-all, or that it's always got to be a guaranteed solution or something else. But I think there could be a couple different options, and several of them may be built into the QDIA. Maybe we, fast forward a couple years, maybe we've got more dynamic QDIAs that are even more bifurcated by different types of participants and personas down the road. So I think that's a key part in building that stuff in.
You know, the Lifetime Income Disclosure Act, LIDA, as it's sometimes called, which is present in a lot of bills, and it was also, its own standalone bill, I think is an important component as well. Talked about this in the earlier session for lunch. When I start thinking of my retirement plan as a monthly income, or a weekly income, or even a yearly income, now it's different. And if I have a chunk that is not guaranteed and a chunk that is guaranteed, assigning probabilities to each of those, or likelihoods that each one will be sustainable, I think is a helpful thing for folks. So as we shift our focus towards how much am I going to get from Social Security, how much can I get from my DC plan, do I have a DB plan, put them all together, what's my monthly number, what do my expenses look like today, that's a real helpful point, I think, for the participant.
Okay. Doug, you're probably more plugged in on this than anybody. Where are they at in requiring monthly incomes on statements? Is that, I mean, I heard that was going to be something that would maybe come through last year, and I haven't heard anything about it since.
If I could predict that accurately, Scott, I would be phoning my comments in from a Caribbean beach. So I mentioned that there's a standalone act. It has been shelved. And the requirement is present in a couple of the bills that are before Congress today. Congress has a few other things going on right now, and so it's anyone's guess as to when some of those pass. But we think that there's a decent chance that, given where Senator McConnell's head is right now, that the Secure Act, which really replaced RISA in the Senate, could well pass as an attachment to a spending bill before the year is out.
So I guess going back to the initial question, like where do you think participants are today? Are they ready at this point? Do you think we need to make a more concerted effort to do education on retirement income and decumulation, or do you think that there's a ready pool of participants who are looking for these solutions and want this today?
My view is that they are ready. We've seen it in surveys. It's just not there, and I think it goes back to the framing. So numerous examples are out there about talking about retirement income not as an annuity, but thinking about it in terms of different language that employees are used to hearing about. I was participating in a webinar a couple weeks ago about this very topic and discussing retirement income in three buckets. One is like a regular retirement paycheck. Another is a general bonus. You think about, RMDs or drawing down some other assets, and then having an emergency fund. So those kind of three buckets, when you put that mentally in your head, it mimics how many of us and many Americans think about our working years. And that's something that's relatable, it's not foreign, and it's an extension of everything that somebody's been doing for 30 or 40 years. So I think they're ready, we just got to frame it up a little differently.
Sure. I used to start conversations with individuals of saying, well, what about the paycheck for the rest of your life? And the idea of a paycheck resonates with everybody. And it might be the first time that they think, oh, that's going away. And then that's when they have to think, oh, I have this pile of assets. Yeah, I need a paycheck though. And that's how I would typically open those discussions.
Yeah, and I think it lends itself to broad enough categories that you can put in any different retirement income generator. And so, there's a lot of different solutions out there.
I think you're right on, Matt. Our surveys have shown similar things. Participants very much want access to a more secure stream of income, whether it's fully guaranteed or otherwise. And Scott, I think you're right as well. Our surveys show that participants do trust their employers, and some of that is because the employer has access to more knowledge and more support to make decisions about different options for individuals. And it's less readiness on the part of the participant, I think, and more willingness on the part of sponsor, advisor, and provider to make it happen.
Totally agree. Yeah.
Well, let me pause for a second. I just want to see by hands in the audience from record keepers or plan providers. Through your participant websites today, how many provide education on decumulation or retirement income? So, a lot of you? Yeah. Do you think it's where it needs to be? Show of hands. Do you think you could do better? Show of, for people who raised their hand before, how many people think that they need to do better? Maybe they have some stuff, but this needs to be looked at. So still quite a few of you. Okay. Well, let's segue over to products a little bit. We talked about product innovations a little bit before. So in terms of making products more accessible at every level, what are some of the innovations or service strategies that you've been working on or that you see in the marketplace that are notable? Oh, go to Scott or Doug.
Well, let's start. Yeah, let's start with QDIA. I trust my employer. Mm-hmm. My employer has some fiduciary skin in the game. My employer's got access to good information and good support. The default is probably not a bad thing. Mm-hmm. So if we're thinking about how to get started, it's got to be from a default perspective. We touched on also the notion of the lifetime income disclosure and how that changes the conversation from a pile of money to a stream of money. And I guess the last thing that I would offer in this regard is that our ability to make things more complex ought not to be the first place we go to when we are talking about these sorts of things with participants. So when we are presenting information, and I'm talking about literal physical sort of layout presentation, we should be conscious about keeping it simple and straightforward. Not that the world is binary, it's either black or white, it's either yes or no, it's either on or off, but rather, here are some simple truths, here's the disclosure that needs to go with it, make up your mind on your own. Let's keep it bold.
Okay.
So I would say a couple of things that I'm either working on or seeing in the industry now that may be a little bit different than previously is around collaboration. There is now a lot more activity between firms in this room that are talking about bringing kind of their best-in-class capabilities forward and partnering on income solutions. And so that feels a little bit better when we're all working together solving this problem and helping to grow the pie and solve an issue across America. And that I feel is different than maybe it was 5 years ago, 10 years ago.
Okay. Scott,
I totally agree with both of them. What Matt just said is right. There's more collaboration than I've ever seen. I mean, things that we're working on have 10 different providers and companies and record keepers and insurance companies like literally working together, and it's enjoyable to see, and they're sharing best ideas. I mean, I've learned a lot from Doug in the last year on talking about product, learned a lot from Matt, like that's why we're probably all up here, and there's just been so much collaboration in trying to figure out topics that had to be fixed, portability, multiple insurers, just things that needed to be, and so it's really neat. I think he nailed it. The collaboration has been really enjoyable, a lot of fun to see. Yeah.
Okay. One thing I've seen with a few retirement plan providers that I liked was a retirement income concierge service. So a dedicated group of individuals that pre-retirees or retirees could call, and they're very familiar with topics such as the in-plan or out-of-plan income options and decumulation and a whole host of topics. But I thought it was nice to have a specialty group that participants could access, and it's not talking to a generalist, it's talking to somebody that talks about distribution all day long. And I'm going to give a shameless plug here when we're talking about innovations. One of the things that DST, now SS&C, has developed, we actually have a portability tool to move in-plan options from one record keeper to another. So everyone keeps talking about that'd be great, this is an obstacle, but we've actually had this for a number of years. So we have attempted to break down these obstacles one by one, and I know portability is a big one. How about any other ideas that you're seeing out in the industry that are interesting, worth considering? Maybe not a home run, but something that you've seen at your firm or competitor?
You know, this is somewhat related to your question here, but I'm going to key on the interesting part, which is, you know, it's interesting to see how some firms have taken a view to be out there with press releases and a lot of publicity around this space, even before a solution has been launched. And other firms are working a little bit more covertly in the background, trying to come up with something and carve out a niche. So I find that just, you know, different perspectives there is pretty interesting. Overall, glad to see, obviously, that we're having these conversations, that these are a bigger part of our conferences and a bigger part of the dialogue across, you know, our industry.
Can I I'm gonna hop in on that? And
Yeah.
two things I guess I would offer. One is, in your question earlier, Mike, you talked about a concierge service. And you talked about trading off between different products and different services. And as you were saying that, maybe this reflects the scars of someone who's come through the DOL fiduciary reg battle and is getting ready to do it all over again. Why not do it twice? And Reg BI too, for that matter. It sounds an awful lot like advice to me. And that's not really the topic of this panel, but I think it is a very important consideration for everybody in this room. And it is something that needs to be incorporated as we think about delivering ways to address the challenges of participants. I need to save enough to have a reasonable amount of income when I'm retired, and I need to figure out a way to make it last as long as I live, and maybe I have a bequest motive as well. The other thing that's interesting from my perspective is to see the work that's being done in the world of the spend down fund, or the payout fund, if you will. Not so much on the fund itself. I mean, look, again, I'm an investment geek. I like that kind of stuff. But the participant experience component and how you access the participant and how you keep the participant engaged, because it's important. If I'm in a fund that says you can only spend X, and that number goes down from one year to the next, I better get communicated to on that. And I better behave right, otherwise I'm going to be in trouble. That's an interesting dynamic. That is a new, and it kind of goes back to advice a little bit. I'm not saying it's advice, but sort of it's the notion of communicating in an engaged fashion on an ongoing basis with participants. That's a big thing for us on a go-forward basis, especially as we look to conquer the issues specific to the decumulation years.
Well, you bring up an interesting point, talking about the non-guaranteed products. What are your thoughts, just for the panel, if we're going to be plugging away at plan sponsors and participants and advisors? It's sometimes hard to be all things, all people. Do we really promote both types of products? Do we go with one that leads into the other? Any thoughts of that guarantee versus non-guarantee, product perspective?
I'm out. Just being an advisor in my 25th year, I think I have pretty strong opinions about this. I think you have to have the guarantee if you're going to talk about income for them. I don't want this to come out the wrong way, but without it, it's essentially just another form of asset allocation. We've already had that. And I understand the tools are different and they can help with the Monte Carlo simulations, but it's still a simulation. It's still, we're going to do our best effort to replace that income. I think the guarantee gives them peace of mind. And if we're really going to get participants to behave well, they need to know that guarantee is there. I think why fight the fight? You know what I mean? Because it's not a question of expense. They're not going to worry about the expense. So, and it's interesting because the record keepers have vastly different opinions on this. I mean, Prudential's been a leader in this space with having guaranteed products, and you have Fidelity who wants nothing to do with it. And it's really interesting the different mindsets. And so, but yeah, I think you have to have a guarantee.
So we worked very hard on our slide, and everybody can see who writes my paycheck. So I believe the guarantee is important as well. But I don't think it's an all or nothing here, right? As long as we're having conversations about retirement income, and guarantee could be a component of it, there could be other sources in there. I think we work together to bring the best of what every firm has to offer here. and collectively grow the pie. I mean, we do have an issue to solve here. It's not going to be a one-size-fits-all across the board. I think there's a role for every firm to play here, whether supporting some guarantees, whether supporting tools and services, customer experience, supporting advisors, all that stuff. Bringing together, the best of what this industry has to offer is going to be key, and that will, be the condition for success.
Can I
please.
throw in my 14 cents?
Of course.
So if I was thinking about this earlier. I'm going to decompose what we turn to large financial institutions to help us solve problems that we cannot or will not solve on our own. What are the sorts of things that 1, 2, 3, all 4 of us could, and a huge industry that, we're the proxy for a very large industry of smart, dedicated people who work real hard. What are the 4 things that we can do for individuals that they can't or will not do for themselves? Number 1, and this may not be an exhaustive list, but asset allocation and periodic rebalancing. I am so lazy, personally. I'm paying somebody 30 basis points to rebalance me. I know how to rebalance. I just don't want to do it. And in a world where you could get an index fund for a third of that amount of money, or 0 basis points, 30 bips seems pretty rich, but my time has a value. The second issue is hedging. How do we make ourselves less exposed to a market that bounces around? And I'm not just talking about equities, I'm talking about bond prices and interest rates. The third and the fourth are kind of related. How do we deal with longevity? And how do we deal with behavior? And behavior may be the final frontier. I always say to folks, mostly my kids who are sick of hearing it, your behavior has much more to do with your final investment outcome than does the behavior of your investments. Give me a great plan lineup, and I will show you a wonderful way to screw it up.
You tell your kids this?
Yes.
I'm trying to get my kids to behave at all.
And
So you're being thrown out of the house, you're being thrown out of the barbacues.
they're like,
Who
"Dad,
are you talking to?
He's the life of the party.
did you just say this at the barbecue this weekend?" No one wanted to hear it. We certainly don't. But we can conquer part of the last issue. How do you keep me calm during market turmoil with non-guaranteed solutions? And we can certainly do a lot of good with the first 2, asset allocation and hedging. You don't need a guarantee for that. You just need to partner with a really smart, big, financially strong institution. Can't conquer longevity without risk pooling. Can't conquer longevity without actuarial hard work in the background. And so if the final frontier from that perspective is let's make sure I don't run out of cash, I'm probably going to want to access a guarantee for at least part of my assets.
Mm-hmm. And you were mentioning or going into behavioral finance. I would also argue that someone who's able to cover their basic expenses, so whether it's their remaining mortgage, utilities, things that they need to survive, I think there's a certain comfort in having those covered for the rest of your life that people will probably be more apt to adopt these type of products, just making that type of statement, thinking, I'll always have food in the fridge, I'll always have a roof over my head, even if I lose everything else, I'll have this forever. I think that's a big thing to say to somebody. Okay, so as a final note, as you know, Spark hosts a variety of constituencies, and we have record keepers, plan sponsors, technology providers, advisors. What are your parting thoughts to each of these audiences in the room? What do you want them to leave with? Scott?
I don't think anything that you don't already know. I think what Doug just said, the 4 points at the last one, was that you have an ability to have a massive impact on participants' behavior, their outcome. And if we can all get behind as an industry making this a QDIA type solution where it's the norm, not the exception, then we could really, this is probably the most important thing, in my opinion, that would change the industry if every plan had a good in-plan product and there was high utilization. It would help participants, it would remove stress, they would save more, they would behave better in bad markets. I mean, it's literally one thing we could all do and get behind that I think could transform the industry. I think it's the one thing that this industry is really lacking. But I mean, I think we have an opportunity to do something special as a community. So.
Yeah, similar to my comments before, I think we have a shared responsibility and a shared opportunity here.
Yeah.
So let's let's have more dialogue about it and more collaboration across different entities in this room and beyond about what to do and some of the solutions that we can bring forward.
Doug?
Whether you're a sponsor or an advisor or even a regulator or a legislator, tap into the combined expertise of folks who are neck deep in this sort of thing. We are ready, willing, and able to have a deep conversation. And I'll go so far as to say, engage us and expect a broad and multifaceted view of things. We'll talk about the good. Yeah. We'll also talk about the bad and the ugly, and help you get better educated and make the right decision for your demographic.
Yeah.
Great. Well, let's take a few questions from the audience. Looks like we have a few minutes left. Would anybody like to ask the panel a question? I know it's after lunch, but...
Did you like our slides?
Yes.
How would you use participant gap analysis to figure out what's the best annuity product for someone?
That's a good question.
How would you use participant gap analysis to figure out what's the best annuity for someone? That's advice. And so you start with advice and the ability to deliver that advice. Interestingly, in a world where AI, excuse me, has more and more currency, there are programs and there are smart players in this market today who can help with that analysis. And I think one could go, you could go in one of two ways. One is pure artificial, sort of methodological, if you will, objective methodology, or just full-blown advice for an individual. And there's a trade-off there, obviously. It costs a whole lot more, both implicitly and explicitly, to deliver advice. I don't know if you guys would amend that at all.
I would just maybe take, with what you said and then add a piece to it, which is, there's an opportunity there for customer experience for those folks who want to be engaged and look at that as an input to their income planning, and blend that with a number of other inputs to determine what does that retirement picture look like. Do I have enough to cover my basic needs, the food, the shelter you talked about? Am I thinking about the retirement paycheck? And then what are the other sources of income I can draw upon for various things?
Yeah, I don't know that I have a good answer for that. I think it's a deep question. There's so many different ways you could analyze. I do think, just steer off it a little bit, I think that the ability to show on a gap analysis the absolute guaranteed minimum that they'd have, like an actual factual amount, would bring some comfort to it, as opposed to a simulated hope, I think you're going to end up here. Just showing, I was talking to Jim at lunch earlier, who's up here, and he said, he goes, to be able to show them the minimum, and it's only going to be better than that, or it can only be better than that, is a very different conversation. So.
And if I can chime in a little bit, again, I'm looking at this through an insurance company lens because that was my background, but we used to use tools that would do stochastic modeling on the variable or equity components, and then we would also do basic needs assessment and really, at a minimum, try to meet someone's basic needs with lifetime guarantees, but also show them what's the impact of doing this with your portfolio over a 20, 30-year time horizon using the stochastic modeling, so they could see that it wasn't just all about income, but this was also helping the rest of their portfolio because they could be maybe a little bit more aggressive knowing that their basic needs were met. But we weren't looking for the best product out the industry. We were looking, how do we position lifetime income? So I know it's a little different than what you're asking, but that's a great question.
A very good question.
That's a great point, though, the guarantee, giving them an opportunity to be more aggressive elsewhere.
Oh, absolutely.
Yeah.
Absolutely. If anyone wants to talk about that afterwards, I have years of working with people going over this. I think I saw one more hand. I think we have time for another question or two. No, we were that good. Yep, here we go. I don't know if everyone could hear, but this has to do with giving the plan sponsor some protection when maybe selecting a provider, doing due diligence. Is there a safe harbor? So I think you guys know something about this.
You actually brought up a little bit about what's in place today and then what's coming down the pike. And
let's make it easy. There is a field assistance bulletin from 2015 issued by the Department of Labor, which talks about both the 2008 original safe harbor and then expands upon it a little bit. That's a great start point. I say go to the field assistance bulletin and not to the original reg because The original reg is written the way you'd think a bureaucracy would write it, and the other one comes in the form more or less of a letter. It's much, much easier to understand, and it expands upon it. The safe harbor is there. The safe harbor is in place. Mark Pester talked in some detail earlier about what the components of it are. The expansion of the safe harbor present in the bills that we talked about before, Family Savings, RISA Secure, and the Portman-Cardin bill, simply says you may rely upon the information compiled in the case of a guaranteed product by each of the state regulators as a definitive source for looking at financial creditworthiness, if you will. And happy to go into much more very arcane detail on that as well. So the point is, safe harbor is there. We may be expanding it, and the way to address those issues is pretty cut and dry in that field assistance bulletin.
I think about it as what's in place today is basically telling fiduciaries to go and do some analysis and get comfortable that an insurer is going to be able to make good on any guarantees down the road. And for many people, they're like, where do you start? What do I look at? I mean, I don't want to go pouring through insurance company financial statements. That's just not the business that they're in. The proposals on the table make it so much easier in terms of just saying, look, you can get a representation, and that's good. You can check the box.
This kind of gave you a roadmap, essentially, would be the next stage of this. So, but on the QDIA aspect, it's likely these will be split QDIA type solutions where you keep your current target date in place and then add whatever version of in-plan income you're going to add. The normal range we typically see is people saying 50 and older. They'll default to that, and anyone under, they'll default to the other solution, or there's various methods of that, but it's likely to be a split type product. Although there's some companies that I know that Income Flex, for example, Prudential, if I remember right, they don't have the insurance until you turn a certain age, and it's a really innovative. They kind of figured that out without having to split it. So there's some. I think you're going to see some really neat things, but the QDIA is going to have to be in play for this to work for everybody. So.
Great. Well, I think we're right at time, so if everyone will just join me in thanking our panelists today, and thank you for your time.
Thank you, guys.